In our last lecture, we learned about the language of financial reporting. Today, we'll learn about corporate analysis and valuation, which uses some of those concepts. Getting a handle on a corporation's value is an inexact science that depends on lots of assumptions. Think of what this task entails. We're taking a huge entity that may operate on 5 continents, controlling assets worth hundreds of billions of dollars, employing tens of thousands of people, competing with dozens of similar companies, and with new products under development, some barely on the drawing board. Yet we're trying to boil it down to a dollar value. How can we even begin to do that? We're going to find that if it's possible to value a company at all accurately, it's not easy. In fact, you'll probably decide that you don't need to do formal valuations. The reason we want to learn about valuation is that by understanding what drives corporate value, we'll understand why businesses make some of the decisions that they do, and we'll understand the limits of our knowledge. Many different valuation techniques exist, and it's rare that they'll agree on just how much a company is worth. That tells you that valuation is a horribly difficult problem and that there's no consensus on how to solve it. We have to deal with incomplete information, unverifiable assumptions, and even inconsistencies. Most analysts use one of 2 approaches to estimate the value of a company's stock. Some use a discounted cash flow approach. That approach has 3 steps. First, you try to forecast any of several values for the next few years. Common choices are dividends, earnings, and cash flow. Second, you estimate how much that stream of dividends, earnings, or cash flow is worth today. That's where the discounting in the name of this approach comes in. Third, you add your own secret sauce. Some analysts think growth is more important than the market's consensus, for example, and some focus on management quality. Show me 50 analysts and I'll show you 50 different secret sauces. A good analyst knows that in step 2, she's computed an estimate of the stock's value. It's a starting point for further analysis, and nothing more than that. The second main approach to valuing firms is the relative valuation technique. Analysts calculate a set of ratios that they think distills a company's value in the best, or at least the best workable, way possible. This approach also has 3 steps. First, you calculate the ratios. Common choices are the price to earnings ratio, the price to cash flow ratio, or the price to book value ratio. Second, you compare that ratio to those of competing firms in the same industry. For example, on July 11th, 2013, Lowe's was trading for about $43 or $44 per share. Its earnings over the last year were about $1.75. That works out to a price-earnings ratio of 24.92. Investors were paying almost $25 for each dollar of earnings that Lowe's produced. Home Depot's PE at the time was about the same, 25.30. You can see the appeal of this approach, can't you? 2 similar companies should have similar PE ratios, and if they don't, then you can make the case that one is overvalued relative to the other. The third step is once again adding the secret sauce, or the analyst's judgment. If you look more closely at the first valuation approach, the discounted cash flow valuation model, you'll see that dividends are the variable of interest. On July 11th, 2013, when Lowe's PE ratio was about 25, its annual dividend was $1.56. We need to estimate those dividends going forward. Go ahead, make your forecast. I'll wait. No, actually, I won't wait. Did you come up with an estimate, or did you freeze up for a second because you realized just how hard this is? And we're only on the first step. Let's take a guess at what those dividends will be. Let's say that Lowe's dividend grows about 1 percentage point faster than the rate of inflation, and let's guess that inflation will be about 2% annually. That would mean a dividend increase of about 3%. If we're right, then next year's dividend will be $1.61. There. If our assumptions are correct, we have 1 year done and an innumerable number to go before we finish the first step of this process. Analysts recognize a bad job when they see one, so they look for assumptions that let them apply some standard mathematical techniques to simplify the problem. A common assumption is that dividends will grow at a constant rate. Let's assume that. We still need a way to handle the second step, which is estimating how much those dividends are worth today. That's at least as hard to do as estimating the dividends themselves. Analysts attack this through the process of discounting. That involves an algebraic transformation of the terminal value equation we learned in Lecture 6. I'll refresh your memory. The formula for figuring out compound interest is terminal value equals the investment times the quantity of 1 plus the rate of return raised to the time invested. Transforming that equation for discounting is easy. What's hard is finding the interest rate to use for discounting. Analysts have lots of different ways to do this. Most add a risk premium to the rate on government securities. Let's do that. The rate on government bonds on July 11, 2013 was about 2.5%. How much should we add for the risk premium? Pablo Fernandez of the University of Navarra reviewed 150 textbooks on corporate finance and found a range from about 3% to 10%. Most were about 6%. So let's use that. That gives us a discount rate of 2.5% plus 6%, or 8.5%. We've made 3 huge assumptions already. We've assumed a dividend growth rate and a discount rate, and we've also assumed that the discount rate would be constant. If you're comfortable with those assumptions, though, the calculation just became trivial because mathematicians have shown us how to collapse this into a simple expression you can solve on any calculator. If you want the formula, just do a web search for dividend growth model. In this case, the answer turns out to be $29.21. That's about $14 or $15 less than Lowe's price on July 11, 2013. If we're right, then we should sell Lowe's before the market notices its mistake. If you're not comfortable with this whole process and with those assumptions, then that's great. You should be uncomfortable. We didn't quite pull those numbers out of thin air, but we definitely have to realize that our estimate is just an estimate and small changes can matter a lot. For example, if dividends grow at 5% instead of the 3% that we assumed, then our estimate of Lowe's stock price jumps to $46.80, and we should buy Lowe's at $45. We should also buy if our estimate of the dividend growth rate is just 1 percentage point higher and our estimate of the equity premium is just 1 percentage point lower. You can see why analysts use a lot of their special sauce at this point. We use the dividend for our discounted cash flow example. Some analysts used earnings or cash flow instead. If you calculate those estimates, then you'll find that the market price won't agree with them either. I can think of several reasons why that might happen. First, the market price may be too high or too low to make the stock a fair investment. I'm not going to stand here and say that the market price is always accurate, and maybe you've found one of those times when it isn't. Second, and more likely, your estimate might be too high or too low. Why might that be? We've seen one answer. The assumptions that underlie the estimates might be wrong. Another reason could be that you're working with old information. On January 15th, you'll be lucky if you have financial statements from December 31st. And even if you do, then a lot can have happened in those 2 weeks. The underlying math and economic theory says that we could have used earnings or cash flow and gotten much the same estimate as we did with dividends. In practice, the various approaches often differ substantially. It's those simplifying assumptions at work again. Because discounting can be difficult and tedious, lots of analysts prefer to use a relative valuation technique, the second approach that I mentioned earlier, instead. The idea is to look at the relationship between the stock price and various determinants of value for similar firms. We've already mentioned the price-to-earnings ratio. We learned that to calculate the ratio, you divide the company's stock price by that company's earnings per share. Analysts in the media also call the PE ratio the earnings multiple. Home Depot's PE was 25 in early July 2013, so people were saying that Home Depot's earnings multiple is 25. That means the same thing as Home Depot is trading at 25 times earnings. Like all of the other tools in corporate analysis, the PE ratio has its share of problems. One is the nature of accounting earnings. Generally accepted accounting principles, or GAAP, allows lots of flexibility. Hey, if you're trying to get a good picture of a huge, complex organization down on paper, then you need some flexibility. But that does make interpretation of accounting numbers and ratios like the PE tougher. For example, did the company incur a big one-time expense last period? That would have lowered earnings and raised the PE ratio. But that will be temporary if it really was a one-time charge. How do analysts use PE ratios? In December 2013, McDonald's PE ratio was 17.7. Wendy's was 247. We could conclude at least three things. We could say that McDonald's was underpriced relative to Wendy's. Or we could say that Wendy's was overpriced relative to McDonald's. Finally, we could say that Wendy's sold at a relative premium to McDonald's because its future earnings were likely to grow lots faster than McDonald's. The first two say that you trust the PE ratios and the assumptions underpinning them more than you trust the market. If so, then you should sell Wendy's and buy McDonald's. The third one says that you trust the market more than the PE ratios and that you need to study these stocks more. I know which way I'm betting. You have to be careful with PEs. They're helpful, but they can't be the only tool in your toolbox. Although PEs get taken too seriously sometimes, there's some evidence that they do predict stock returns. No, it's not perfect, but over a long period of time, buying low PE stocks tends to be a good strategy. Suppose that we look at the historical relationship between the stock market's overall PE ratio and the market's return over the next 10 years. Let's pick a long period from 1901 through 1998. What you'll find is an imperfect but fairly convincing relationship between PEs and subsequent returns. The higher the PE, the lower the subsequent 10-year return tends to be. On average, an increase of 1 in the PE, maybe to 15 from 14, tends to produce an annual return of about 0.6 of 1 percentage point less. Over 10 years, that's over 6%. Although individual stock PE ratios are highly variable, PEs over 25 for the entire market are uncommon. In fact, there are only about 3 or 4 during this sample of almost 100 years. None of those were followed by particularly good annual returns, and the average return was only about 1% per year. What's going on here? Have we found a way to earn abnormal returns? Maybe. The evidence does suggest that we do better in the long run if we buy low PE stocks and sell high PE stocks. That's not quite the same as finding a profit opportunity, though. For example, we've already seen in Lecture 4 that there's a relationship between risk and expected return, and that in the long run you'll tend to earn more if you take more risk. Perhaps low PE ratios come with higher risk. If that's true, then investors who buy low PE stocks should tend to make more in the long run. If you were to graph market PE ratios from the 1880s through 2010 or so, you'd find that they spent most of their time between 10 and 25. If the PE got below 9 or so, then eventually it rose fairly rapidly as stock prices subsequently climbed. That happened 3 times, from the market bottom in the early 1920s through 1929, from 1933 through 1936, and again from 1982 through 2000. You'd also see that if the PE got above about 25, then eventually it declined, again fairly rapidly. That happened twice, from 1929 through 1932, and from 2000 through 2002. One way to look at this is to conclude that when PE ratios get below 9, then you should buy, and if they get above 25, then you should sell. There's a problem with that, though. If you did that, then you would have tended to sell or buy too soon. You would have bought in about 1918 instead of the early 1920s. You would have sold about 1926 instead of 1929. You'd have bought about a year early instead of hitting the sweet spot of 1933, and you'd have sold in about 1995 or 1996, way before the declines began in 2000. That's looking at the dark side, and I won't blame you if you decide to look on the bright side. Using this PE trading rule did tend to find the market turning points, at least within a couple of years. You might feel comfortable being off by that much. Whether you decide to look on the bright side or the dark side, though, remember the disclaimer. Past performance is not necessarily indicative of future performance. Now I'm going to make the argument that changes in risk are at least part of what's driving this. If you were to overlay your graph of PE ratios with some measure of the interest rate, then you'd learn that interest rates and PE ratios tend to move in opposite directions. Interest rate increases roughly correspond to declining PEs, and interest rate decreases roughly correspond to rising PEs. That makes perfect sense because high interest rates tend to be associated with risky times. If we look at the data through that lens, then we see that stocks tend to do well in risky times while they don't do as well during safe times. That's reasonable. Think of it this way. In risky times, investors collectively look at earnings and say, "Those earnings look shaky to me. I'm not sure those companies are going to be able to grow or even maintain those earnings. I'm not buying unless the stock price is low enough to compensate for the risk." That translates into a low PE ratio. Flipping the argument around, if the world looks reasonably safe, then investors collectively look at earnings with more confidence. Those earnings look solid. I'll even pay a high price because the odds are good that the companies are going to be able to continue to show good earnings. That translates into a high PE ratio. Viewed this way, the strategy of buying when PE ratios are low and selling when they're high might get you higher returns in the long run, yet be completely consistent with an efficient market. You tend to earn more when PEs are low, but you have to take more risk to earn it. The price-earnings ratio may be the most popular of the relative valuation techniques, but it's far from the only one. Some analysts prefer the price-to-cash flow ratio. Some like the price-to-dividend ratio. And some favor the price-to-book value ratio, which is often called the market-to-book ratio. The idea behind these is the same as for the PE ratio. For example, the price-to-cash flow ratio reflects the amount that the market will pay for a dollar of cash flow. One place to get cash flow information is from a statement that public companies have to file quarterly called the 10Q, or the Statement of Cash Flows. You can get these from the company or online. Search for Free Edgar, one word, on the SEC's website. Analysts know that using book values has lots of problems. First, book values are based on historical values of assets and liabilities, which may not reflect current values. Another problem with book values is that some assets, such as valuable brand names like Ferrari, aren't always on the balance sheet. Some people think that book value represents the floor for the market price of a stock. That's a mistake. You can always find several companies with market prices below book value. These aren't obscure firms either. You've heard of Citigroup, the parent of the colossal bank named Citicorp, haven't you? Citicorp's assets in 2010 were about $2 trillion, and it was trading below book value for much of the year. If you want a floor for the stock price, at least in the near term, then a better measure is the firm's liquidation value. The liquidation value is the amount you'd have if you dismantled the company, sold to pieces, and repaid the debt. Whatever's left is the liquidation value. The reason that's a reasonable minimum value for the company is that if the market price drops below that, then some other firm can buy the company on the open market and liquidate it, making a profit in the bargain. But even the liquidation value isn't an absolute floor for the stock price. The reason is that it might not be possible to liquidate the firm. The poster child for this sad case is Eastern Airlines. Some of you are old enough to remember Eastern's slogan, "Fly Eastern, #1 to the sun." Eastern filed for bankruptcy on March 9, 1989, during a pilot strike. Eastern was losing money with every flight. Under the circumstances, the best thing to do was stop the bleeding, shut down, sell the company in pieces, and get on with life. Unfortunately for investors, the bankruptcy court wouldn't allow this. Eastern had to keep flying. The court finally relented and Eastern shut down on January 19, 1991. During the 22-month delay, continued losses drove Eastern's value down by over half. There wasn't much left by the time the company was liquidated. Unsecured lenders recovered only about 11% of the value of their claims, and stockholders lost everything. If you had bought when the company filed for Chapter 11 protection, thinking you'd get at least the liquidation value at the time, then you'd have lost your entire investment. If the book value has so many flaws, then why does anybody use it? One good reason is that it might be all you have. Privately held companies don't trade often, and when they do, the price isn't set on an open auction on an exchange. You see a lot more negotiation in those cases. At what price do you start those negotiations? You can't look at the market price, and you can't compute a P/E ratio to see if it's comparable to similar companies either. Sure, book values have problems, but in the land of the blind, the one-eyed man is king. Using ratios of publicly traded companies has limitations as well. For example, lots of publicly traded companies simply don't have earnings. Well, they do, but they're negative. These companies report a loss. That means that the P/E is negative. There's just no way to make economic sense of that. So the P/E is useless in such cases. Analysts have even less information for startups. There's no market price. There's almost never any earnings. There certainly aren't any dividends. Estimates would be little more than wild guesses. Analysts like to say that the only thing we know about these estimates is that they're wrong. For companies with no current earnings, analysts fall back on some other approach, like a discounted cash flow approach. Some turn to the market-to-book ratio, some turn to the price-dividend ratio, and some turn to one of several others we haven't had time to cover. Every one of those approaches has its own problems. Good analysts have a lot of arrows in their quiver. By now, you might be throwing up your hands in frustration. With all of these problems, you say, why bother with valuation at all? The answer to that depends on what you need to know. If you own half of a small, privately held business and you're nearing retirement, then you might want to sell your half of the company to your business partner. You need to find a value that seems fair and makes sense for both of you. Or you might be buying a supplier or even a competitor's business. Without using some type of valuation technique, you won't have any idea of the right price. These valuation techniques can help establish a good starting point for negotiations. For stock market investors like us, though, the answer may be, for investing purposes, I'm not sure that you should bother. We're not going to have the time or the inclination to put forth the effort needed to compete with experts who do this sort of thing for a living and are backed by big investments in technology and who have access to huge amounts of current data. But not using something isn't the same as not learning about it. Even if you decide not to use these valuation techniques, you'll go to bed at night knowing a little bit about what's hiding under the bed. You'll find that it's much less scary than the unknown. To me, though, the best reason to learn a little about valuation is to understand what drives corporate value, earnings and cash flows, and the discount rates that analysts apply to them. As we've seen, these estimates of corporate and share value are incredibly sensitive to tiny changes in the assumptions underlying the calculation. Remember how much our estimate of the value of Lowe's stock price jumped with just a tiny change in the dividend growth rate or the discount rate? All valuation approaches require data. High-end analysts spend big money to buy data from real-time sources like Bloomberg. Where can people like us get data? Unless you're prepared to spend thousands of dollars, you won't find data to match the big players. But the internet does provide a convenient way to access corporate data. One example is the Securities and Exchange Commission's Electronic Data Gathering, Analysis, and Retrieval System, more commonly known as EDGAR. The SEC requires that all U.S. corporations with more than $10 million in assets and at least 500 shareholders file corporate financial data. These data are available free to anyone with internet access. What will you find on EDGAR? You'll find hundreds of current and historical filings on just about any company you want. You'll find everything from annual reports to something called a notification of the removal from listing and registration of matured, redeemed, or retired securities, for goodness sake. EDGAR is a goldmine of information if you're willing to dig around the SEC's website. Another helpful source is ValueLine, an investment advisory service founded in 1931. Lots of smart people love ValueLine. ValueLine has a reputation for doing careful research, and there's no doubt that the way they present the information is a big plus. In just one screen, you'll find the company's name, the exchange where it's traded, a recent price, the dividend yield, plus ValueLine ratings for timeliness, safety, and the firm's technical score. You'll find more than 15 years worth of selected ratios such as sales per share, cash flow per share, and earnings per share. You'll find annual sales. You'll also find 2 or 3 years worth of balance sheet items, like the ones that we discussed in our previous lecture, plus a business report summarizing ValueLine's company research. Some of ValueLine's resources are free, but the meat of their offerings does require a subscription. I'm a big fan of Yahoo's financial website called Yahoo Finance. A lot of the numbers I use in these lectures come from Yahoo. My students and I think that it's easier to find the information we need on Yahoo than on most other sites. That's partly personal taste, of course. And it's free. We like free. Here's an example of the information on yahoo.com from December 6, 2013. For BioCryst Pharmaceuticals, you'd have found the income statement, the balance sheet, and other financial statements. One click away is the PE of the industry, which was a very high 73. You'd have learned that the price-to-book ratio for the industry was 18.3 and the dividend yield was 1.7%. You'd have learned that BioCryst Pharmaceuticals business is battling bad enzymes that spread disease. This is a good time to illustrate how financial ratios differ across industries. Let's look at publishing newspapers. Gannett Corporation is an example. The price-earnings ratio for this industry isn't anywhere close to biotech's 73. It's just 22. Instead of a price-to-book ratio of 18.3 for biotech, TV broadcasting is negative. The PE comparison is particularly instructive. Investors are willing to pay $73 for every current dollar of biotech earnings, but only $22 for a current dollar of newspaper earnings. That tells me that investors don't think as much of the industry's future as they do biotech. The newspaper industry is probably at or past its peak. In contrast, investors predict big earnings growth in biotech. These big earnings justify the high price. Do be careful when you hear the term growth. Growth per se isn't worth buying. If we double earnings by issuing new shares to double the size of the company, then the company grows to twice its previous size, but we've cut your share of the company in half. Your stake has the same value as before. Growth is only good if the company can earn a higher return than it costs to raise the funds to operate the business. We've only scratched the surface of valuation. We barely mentioned the secret sauce that investment managers use. Partly that's because managers don't like giving away their trade secrets, and partly it's because we could literally spend years on the subject. Knowing when to apply which approach is time-consuming and tough, and that's why professional money managers make big bucks. The next time you listen to the news or check the internet for financial information, you'll encounter some of the terms we've covered today. Take a moment to think about whether what you're hearing makes sense. I'm not suggesting that reporters and their guests are trying to deceive you. They're hitting a deadline, and they have limited space and time. There's no room to define their terms and list their assumptions. Most viewers and readers wouldn't want to hear that stuff anyway. Those assumptions and interpretations are still there, though. Have the commentators picked the right tools for the difficult job of distilling a company into just a few concepts and numbers? In our next lecture, we'll study one of the most successful examples of financial innovation in history, and one that's particularly useful for people like us, the world of mutual funds and other investment companies.